Capital expenditures, often abbreviated as CapEx, are a fundamental aspect of any business's financial strategy. If you've ever wondered how companies expand, upgrade their facilities, or even invest in new technology, understanding CapEx is key. So, let's dive deep into this concept and explore how it can be a game changer for businesses looking to grow and thrive. First, let's clarify what CapEx really means. In simple terms, capital expenditures refer to the funds that a company spends on acquiring or improving long-term assets. Think of it as the money spent on things that will benefit the company for more than just one accounting period. This could include purchasing new machinery, upgrading a production facility, or even investing in a fleet of vehicles. Unlike everyday expenses, which we call operating expenses or OPEX, CapEx is all about making investments that will create future value. Now, you might be asking yourself, why is this important? Well, the significance of CapEx cannot be overstated. For companies, these expenditures are crucial for growth. They allow businesses to increase productivity, enhance efficiency, and ultimately drive revenue. Imagine a manufacturing company investing in state-of-the-art equipment. This new machinery not only boosts production, but also reduces operational costs in the long run. That's the power of capital expenditures. Let's break down the types of CapEx to get a clearer picture. There are four main categories: replacement expenditures, expansion expenditures, strategic expenditures, and compliance expenditures. Replacement expenditures are made when companies need to replace outdated or worn-out assets. For instance, if a factory's machinery is no longer efficient, it's time for an upgrade. This ensures that the company remains competitive and productive. Next, we have expansion expenditures. These are investments made to grow the business. Think about a company that's experiencing a surge in demand for its products. To meet this demand, it might invest in a new factory or office space. This type of CapEx is essential for companies that want to capture more market share and scale their operations. Then we have strategic expenditures, which are investments that align with a company's long-term goals. This could involve funding research and development to innovate new products or services. Staying ahead of the competition often requires strategic investments, and this is where CapEx plays a vital role. Finally, compliance expenditures are necessary to ensure that a company adheres to legal or regulatory requirements. For example, a business might need to invest in safety equipment or environmental controls to comply with regulations. While these expenditures may not directly generate revenue, they are crucial for maintaining a positive reputation and avoiding potential penalties. Now that we've covered the types of CapEx, let's talk about how it's calculated. The formula to determine capital expenditure is quite straightforward. You take the total cost of the asset and subtract its salvage value. The salvage value is the estimated resale value at the end of the asset's useful life. This calculation helps businesses understand the financial impact of their investments. Once you've calculated CapEx, it's essential to understand its relationship with cash flow. When a company makes a capital expenditure, it typically involves a significant cash outlay. This can come from various sources, such as cash reserves, operating cash flow, or even debt. The initial cash outflow impacts the company's cash flow statement immediately, but the effects can be felt long after the investment is made. For instance, consider a company that invests in a new production facility. The cash outflow is recorded when the investment is made, but the future cash inflows generated by that facility will continue for years. This relationship between CapEx and cash flow is crucial for businesses to manage effectively. If a company makes a large CapEx investment, it might strain its cash flow in the short term, but if that investment generates positive returns, it can lead to significant long-term benefits. Speaking of positive and negative CapEx, let's explore this concept further. Positive CapEx refers to investments that generate positive cash flows and enhance profitability. For example, if a company invests in new technology that streamlines operations, it could lead to increased revenues and cost savings. On the other hand, Negative CapEx refers to investments that don't generate positive cash flows and may even hurt profitability. This could include necessary expenditures for compliance or maintenance that don't directly contribute to revenue generation. While negative CapEx isn't inherently bad, it's essential for companies to evaluate these investments carefully to ensure they align with their long-term strategies. Now, let's touch on the differences between capital expenditures and operating expenses. While both are crucial for a company's success, they serve different purposes. Capital expenditures involve acquiring or improving long-term assets that provide benefits for more than 1 year. These expenditures are recorded on the balance sheet as assets and depreciated over time. In contrast, operating expenses are the day-to-day costs of running a business, such as salaries, rent, and utilities. Operating expenses are recorded on the income statement and are fully deductible in the year they are incurred. Understanding these distinctions is vital for financial management. Capital expenditures can significantly impact a company's cash flow and financial statements, and making informed decisions about these investments is crucial for long-term success. So, why should companies prioritize capital expenditures? The answer lies in their ability to drive growth and improve financial performance. CapEx represents long-term investments that yield benefits over time, helping businesses increase production capacity, improve efficiency, and ultimately generate more revenue. Additionally, investing in CapEx can provide a competitive advantage. Companies that embrace new technologies and facilities can capture market share and foster customer loyalty. However, navigating the world of CapEx isn't without its challenges. Companies must carefully evaluate the costs associated with capital expenditures, as they can represent a significant outlay of cash. There's always uncertainty surrounding the potential returns on these investments, and the risks involved can be high, especially for large projects. Moreover, the depreciation of assets can create accounting complexities that affect reported earnings. And let's not forget about opportunity cost. When a company chooses to invest in one capital project, it might have to forego other potential investments. This is why thorough evaluations and strategic planning are essential. Companies need to ensure that they're making the best use of their financial resources and investing in projects that align with their overall goals. In conclusion, capital expenditures are a vital component of a company's investment strategy. They represent long-term investments in assets that drive growth and improve financial performance. From replacement and expansion to strategic and compliance expenditures, understanding the different types of CapEx is crucial for making informed decisions. The relationship between CapEx and cash flow is significant, and companies must manage their investments carefully to ensure they're generating positive returns. As we wrap up this discussion, remember that capital expenditures are not just numbers on a balance sheet. They are the building blocks of a company's future. By investing wisely in CapEx, businesses can position themselves for long-term success, adapt to changing market conditions, and ultimately thrive in an ever-evolving landscape. So, whether you're a business owner, an investor, or just someone curious about the world of finance, understanding CapEx is essential for navigating the complexities of the business landscape. Thank you for joining me on this journey into the world of capital expenditures.